What you're about to witness could reshape the entire global financial system. A quiet signal from Tokyo just sent shockwaves through every major market on Earth, and most people have no idea what's coming next. I'm going to break down exactly what happened, why it matters to your money, and what you need to do about it right now. Here's what happened. Bank of Japan Governor Kazuo Ueda made a single comment suggesting they might raise interest rates in December. That's it. Just a hint of a possible rate hike. But here's why that matters. For over 3 decades, Japan has been the outlier. While every other major economy raised rates aggressively, Japan kept theirs near zero. They've been the world's discount lender, the source of cheap money that's flooded into markets everywhere. Now that's about to change. And when Japan moves, the entire world feels it. The response was instant. Within seconds of that comment, Japanese 10-year bond yields shot up to 1.9%. The 2-year yield broke above 1% for the first time since 2008. Global markets went into shock mode. But that was just the beginning. The tremor spread like wildfire across the Pacific. U.S. Treasury yields jumped by the most in a month. European bonds followed. The entire global bond market moved in unison, all because of one sentence from Tokyo. Why? Because investors immediately understood what this means for the future. Now here's where this gets critical for the U.S. economy and your investments. Japanese investors are the biggest foreign buyers of U.S. Treasury bonds. We're talking trillions of dollars parked in American debt. Think about it from their perspective. For years, they've been forced to buy foreign bonds because Japanese rates were basically zero. But if Japan finally offers decent returns at home, why would they keep their money overseas? They won't. This creates a massive problem. The U.S. government is issuing enormous amounts of new debt right now. They're running huge deficits and need buyers for all those bonds. But just as supply is exploding, one of the biggest sources of demand is about to disappear. It's basic economics. When demand drops and supply increases, prices fall. And when bond prices fall, yields rise. That means higher borrowing costs for everyone. The U.S. government, businesses, homebuyers, everyone pays more. The ripples are already spreading everywhere. The dollar had its worst week in 4 months. When the Fed's rate advantage shrinks and uncertainty grows, the dollar weakens. Simple as that. Tech shares led a major pullback in the stock market. The Nasdaq and S&P 500 both turned red as investors sold off risky positions. And Bitcoin was down 7% in a single day, now over 20% from its recent peak. Meanwhile, the Federal Reserve is caught in a trap. Markets are pricing in an 88% chance of a rate cut in December. The Fed wants to ease because the economy is showing weakness. But here's the problem. If Japan raises rates while the Fed cuts, that narrows the interest rate gap between the two countries even faster. That accelerates the flow of money out of U.S. markets and back to Japan. The Fed thought they'd have room to cut rates multiple times. Now, markets are pricing in just a handful. Japan's potential move just boxed the Fed into a corner. This isn't fear-mongering. This is reality. The cheap money era that's defined markets for 3 decades might be ending. And it's starting in the last place most people expected. Japan, stay alert, stay informed, and understand that what happens in Tokyo doesn't stay in Tokyo anymore. I'll be tracking every development on this story, so make sure you're subscribed so you don't miss the updates. Thanks for watching.